The digital asset world is watching with rapt attention as Bitcoin embarks on one of its most significant rallies to date. As of August 11, 2025, the price of a single Bitcoin has soared past the $122,000 mark, a breathtaking ascent that places it tantalizingly close to its all-time high of $123,218, recorded just last month. This powerful price movement is not an isolated event, but the culmination of a series of powerful forces that have been building momentum for months. The entire cryptocurrency market has been lifted by this tide, with its total valuation reaching a staggering new peak of $4.14 trillion. This surge represents a new chapter for an asset class once relegated to the fringes of the financial system, signaling its powerful and growing integration into mainstream investment portfolios. The primary engine behind this remarkable climb is the unprecedented success of U.S. spot Bitcoin exchange-traded funds, or ETFs. These financial products, which allow investors to gain exposure to Bitcoin without holding the asset directly, have become a dominant force in the market. In just the 3 days leading up to August 10th, these ETFs witnessed a colossal net inflow of $773 million. This influx of capital demonstrates a voracious and sustained appetite from a wide range of investors, from retail traders to large-scale institutions. The sheer scale of these flows has fundamentally altered the supply and demand dynamics of Bitcoin, creating a powerful upward pressure on its price as ETF issuers are compelled to purchase the underlying asset to back their shares. This rally is more than just a number on a screen. It reflects a profound shift in perception and accessibility. For years, investing in Bitcoin was a complex process, often requiring specialized knowledge and digital wallets. The introduction of spot ETFs has demolished these barriers, offering a simple, regulated, and familiar pathway for anyone with a brokerage account to participate. This democratization of access has unleashed a wave of capital that was previously sitting on the sidelines. The consistent day-after-day inflows into these products underscore a broad-based conviction in Bitcoin's long-term value proposition as a store of value and a hedge against economic uncertainty, solidifying its place in the modern financial landscape. The market's optimism is palpable, as evidenced by the Crypto Fear and Greed Index, which currently sits at a reading of 70, indicating a state of greed. While this suggests strong bullish sentiment, it remains below the levels of extreme euphoria that have historically signaled market tops, leaving room for further growth. The excitement is not confined to Bitcoin alone. Ethereum, the second largest cryptocurrency, has also experienced a meteoric rise, nearly tripling its value since April 2025 to trade at over $4,300. This broad market strength, led by Bitcoin's charge, paints a picture of a maturing asset class that is finally being recognized for its potential by the traditional financial world. At the heart of the Bitcoin ETF phenomenon are the giants of traditional finance, who have thrown their immense weight behind these new products. Leading the charge is BlackRock, the world's largest asset manager. Its IBIT Bitcoin ETF has become a runaway success, accumulating an astonishing $80 billion worth of Bitcoin in its holdings. This figure is not just impressive in the crypto world, it is rapidly closing in on the $94 billion in assets managed by the SPDR Gold Shares ETF, the long-standing benchmark for gold investment. This rapid accumulation highlights a historic shift in capital allocation, where digital gold is now seriously competing with physical gold for a prime spot in investor portfolios and treasury reserves. The scale of BlackRock's involvement extends beyond just one fund. The firm has embraced digital assets with remarkable speed, recently adding nearly $300 million in crypto ETF assets to bring its total holdings in the space to a massive $98.9 billion. This level of commitment from a firm of BlackRock's stature has a ripple effect across the entire financial industry, lending an unparalleled degree of legitimacy and credibility to the asset class. Other major players have followed suit, with firms like Fidelity and ARK Invest also managing multi-billion-dollar Bitcoin ETFs. Together, these titans have created a highly competitive and liquid market that makes institutional-grade Bitcoin investment a reality. The numbers tell a story of relentless demand. On August 7th alone, U.S. spot Bitcoin ETFs collectively pulled in $281 million in net new capital, a clear signal that institutional appetite remains robust. This is part of a larger trend that saw these funds attract over $250 million in a single week. This consistent buying pressure from ETF issuers, who must acquire real Bitcoin on the open market to back the shares they create, directly fuels the price rally. Every dollar that flows into these ETFs effectively reduces the available supply of Bitcoin for sale, creating a classic economic scenario where rising demand meets constrained supply, inevitably pushing prices higher. This institutional embrace marks a stark contrast to the initial skepticism that once defined Wall Street's view of cryptocurrencies. The success of Bitcoin ETFs has proven that there is deep structural demand for a regulated and accessible way to invest in the digital asset. As these funds continue to grow and attract more capital, they weave Bitcoin more tightly into the fabric of the global financial system. The involvement of behemoths like BlackRock is not just a temporary trend. It represents a fundamental and likely permanent change in how the world's largest money managers view and utilize Bitcoin as a strategic asset. A monumental policy shift from the White House has added a powerful new catalyst to Bitcoin's ascent. President Donald Trump, in a move widely seen as bullish for the digital asset industry, recently signed an executive order that opens the door for 401k retirement plans to include cryptocurrencies as a potential investment option. This decision is a game changer, potentially unlocking a vast and previously inaccessible pool of capital. The U.S. retirement market represents an estimated $12 trillion in savings, and allowing even a small fraction of these long-term funds to be allocated to Bitcoin could trigger an unprecedented demand shock, dwarfing even the impressive ETF inflows seen to date. This executive order effectively provides a green light for millions of American workers to allocate a portion of their retirement savings to digital assets through their employer-sponsored plans. For years, the idea of holding a volatile asset like Bitcoin in a conservative retirement account was considered taboo by regulators and plan administrators. President Trump's directive signals a significant change in official sentiment, reframing Bitcoin not just as a speculative trade, but as a legitimate long-term investment capable of providing diversification and potential inflation protection. This regulatory endorsement is crucial, as it gives financial advisors and 401k providers the confidence they need to begin offering these products to their clients. The potential impact of this policy cannot be overstated. Financial analysts are already modeling the effects of a mere 1 or 2% allocation from the 401k market into Bitcoin. Such a shift would translate into hundreds of billions of dollars of new, sticky, long-term investment. Unlike the more fluid capital in ETFs, which can move in and out of the market daily, retirement funds are typically invested for decades. This creates a stable and enduring base of demand that could help to smooth out Bitcoin's notorious volatility and provide a solid foundation for future price appreciation. The market is now eagerly awaiting the first major 401k providers to announce their Bitcoin offerings. President Trump's pro-crypto stance extends beyond this single order. He also took aim at what he termed the unfair debanking of crypto-friendly firms, a move designed to ensure these businesses have stable access to the traditional financial system. Furthermore, his nomination of economist Stephen Moran, who is known for his positive views on digital assets, to the Federal Reserve Board further solidifies the administration's supportive position. Together, these actions create a highly favorable regulatory environment in the United States, encouraging innovation and investment in the crypto sector, and signaling to the world that America intends to lead in this new financial frontier. The theoretical potential of institutional adoption is now becoming a tangible reality, with some of the nation's most respected and sophisticated investors making significant moves into Bitcoin. Harvard University's endowment, a financial titan with a long history of savvy, forward-looking investments, has made a powerful statement of conviction. In its second quarter 2025 filings, the university disclosed a staggering $117 million holding in BlackRock's IBIT Bitcoin ETF. To put this allocation in perspective, Harvard's bet on Bitcoin is now larger than its stake in Alphabet, the parent company of Google. This is not a speculative punt. It is a calculated, strategic investment from one of the world's most influential financial entities. This move by Harvard sends a powerful signal to the rest of the institutional investment community. Endowments and pension funds are notoriously conservative, prioritizing capital preservation and long-term, stable growth. Harvard's decision to allocate such a substantial sum to a Bitcoin ETF suggests that its investment committee now views the digital asset as a credible component of a diversified portfolio capable of delivering returns and hedging against other market risks. This endorsement from the pinnacle of the academic and investment world effectively de-risks Bitcoin in the eyes of other, more cautious fund managers who often look to institutions like Harvard for guidance on emerging asset classes. Harvard is not alone in this pioneering move. The Michigan Retirement System, one of the largest public pension funds in the country, has also been actively increasing its exposure to Bitcoin. The fund recently boosted its position in the ARKB ETF, managed by ARK Invest and 21 shares, to 300,000 shares. This stake is currently valued at approximately $10.7 million, representing a significant and growing commitment from a fund responsible for the financial futures of thousands of public sector employees. The involvement of a major public pension plan like Michigan's demonstrates that the appeal of Bitcoin is broadening beyond private endowments to include public fiduciaries. The actions of Harvard and Michigan serve as critical case studies for the thousands of other pension funds and endowments across the country and the world. As these institutions see their peers successfully integrating Bitcoin into their strategies, the pressure to follow suit will mount. The fear of missing out on the potential gains offered by the best-performing asset of the last decade is a powerful motivator. This trickle of institutional capital, led by pioneering funds like Harvard and Michigan, has the potential to turn into a flood, providing a steady and long-term source of demand for Bitcoin that will support its value for years to come. Beyond the straightforward buying and selling of Bitcoin and its ETFs, the derivatives market offers a more nuanced glimpse into the collective mindset of investors. The options market, in particular, provides valuable clues about future expectations, risk appetite, and overall confidence. As of early August 2025, the U.S. Bitcoin spot ETF options market is buzzing with activity, boasting a nominal trading volume of $1.69 billion and a massive open interest of $26.84 billion. These figures indicate a deep and liquid market where sophisticated investors are actively placing bets and hedging their positions on Bitcoin's future price movements. A key metric to watch in this market is the long-short ratio, which currently stands at a healthy 1.71. This ratio suggests that for every trader betting on a price decline, a short position, there are 1.71 traders betting on a price increase, a long position. This is a clear indication of bullish sentiment prevailing among the more active and sophisticated trading community. Investors are positioning themselves for further upside, anticipating that the powerful trends of ETF inflows and institutional adoption will continue to drive the price higher. This optimism is not reckless, but it is a confident endorsement of the current rally's strength. However, the options market also reveals a layer of caution beneath the bullish surface. The implied volatility, a measure of expected price swings, is currently at 40.97%. While this figure is low by historical Bitcoin standards, it still reflects an understanding that the asset can experience significant price movements. Traders are not expecting a straight, uninterrupted line upwards. They are pricing in the potential for pullbacks and corrections along the way. This combination of bullish positioning, seen in the long-short ratio, and a healthy respect for potential volatility suggests a mature and rational market sentiment rather than the kind of irrational exuberance that often precedes a major crash. In essence, the options market is telling a story of confident but cautious optimism. Traders are willing to bet on higher prices, but they are also using options to manage their risk and protect against potential downside. They see the powerful fundamental drivers pushing Bitcoin up, but they remain aware of the technical levels and macroeconomic events that could cause short-term turbulence. This balanced sentiment is a healthy sign for the market's sustainability. It shows that the current rally is not built on pure hype, but on a calculated assessment of risk and reward by a growing number of sophisticated market participants. As Bitcoin challenges its all-time highs, technical analysis becomes crucial for traders and investors seeking to navigate the path ahead. The market structure is defined by key price levels that act as psychological and structural barriers or support zones. The most immediate and significant hurdle is the July 2025 peak of $123,200 $218. This level represents the highest price Bitcoin has ever reached, and breaking through it would be a powerful psychological victory for the bulls. A daily close above this resistance would signal a clean breakout into uncharted territory, opening the door for the next leg of the rally and confirming the immense strength of the current uptrend. Should Bitcoin successfully conquer the $123,218 resistance, analysts are looking at Fibonacci extension targets to project potential future price levels. The first major target zone lies between $126,000 and $129,000. These levels are not arbitrary, they are calculated based on the size and structure of previous price swings and represent areas where the rally might pause or face profit-taking. A sustained move into this range would further solidify the bullish case and likely attract a new wave of buyers who are waiting for definitive confirmation of the breakout before committing new capital to the market. On the downside, several layers of support are in place to cushion any potential pullbacks. The first line of defense is the psychological $120,000 mark, which the price has recently fought to stay above. Just below that lies the 7-day simple moving average, at approximately $116,319, which has been acting as a dynamic floor for the price during this recent push higher. As long as Bitcoin remains above this moving average, the immediate uptrend is considered intact. A more significant support zone is found between $110,530 and $111,920, an area that would likely attract significant buying interest if the market were to experience a deeper correction. Technical indicators are also providing a bullish yet measured outlook. The Relative Strength Index, or RSI, a popular momentum oscillator, is currently at 67.76. This reading indicates strong buying pressure and bullish momentum. Critically, it is still below the 70 level, which is often considered overbought territory. This suggests that while the rally has been powerful, it has not yet reached a point of extreme froth or exhaustion, leaving technical room for the price to continue its upward trajectory. The market remains firmly above its 20-day simple moving average as well, reinforcing the strength of the medium-term trend. The explosive growth of Bitcoin ETFs in the United States stands in stark contrast to the performance of similar products in other parts of the world, particularly in Asia. While the U.S. market is absorbing hundreds of millions of dollars in new capital on a daily basis, the spot Bitcoin ETFs launched in Hong Kong have struggled to gain significant traction. This divergence highlights the unparalleled depth and scale of the U.S. capital markets and the critical importance of the American regulatory environment in fostering investor confidence and driving global adoption. The U.S. has firmly established itself as the center of gravity for institutional Bitcoin investment. The numbers from Hong Kong paint a clear picture of a market that has yet to take off. Over the past week, Hong Kong's spot Bitcoin ETFs recorded zero net inflows, a startling figure when compared to the $253 million that flowed into their U.S. counterparts during the same period. The total assets under management for all Hong Kong Bitcoin ETFs combined is a mere $49.7 million. This is a tiny fraction of the tens of billions managed by a single U.S. provider like BlackRock. The holdings of the issuers themselves are also dwindling, with Harvest Bitcoin holding just under 293 BTC and Huaxia holding 2,290 BTC. Several factors contribute to this vast disparity. The U.S. financial ecosystem is simply much larger, with a deeper pool of institutional capital, a more developed wealth management industry, and a larger base of retail investors with access to sophisticated brokerage platforms. Furthermore, the regulatory clarity and institutional backing provided by giants like BlackRock and Fidelity in the U.S. have created a level of trust and legitimacy that other markets have struggled to replicate. Investors, both domestic and international, appear to favor the liquidity, security, and competitive fees offered by the U.S. ETF products. This global comparison underscores the significance of the U.S. market's embrace of Bitcoin. The success of the American ETFs is not just a local story, it has a global impact. It sets a benchmark for other jurisdictions and forces international asset managers to take notice. The immense liquidity and price discovery happening within the U.S. trading hours now dominate the global Bitcoin market. While other financial centers like Hong Kong may yet see their markets grow, for now, the story of institutional Bitcoin adoption is overwhelmingly an American one, driven by the unique combination of regulatory progress, institutional muscle, and an insatiable investor appetite. Bitcoin's rally is not occurring in a vacuum. It is being bolstered by a favorable macroeconomic environment and a series of positive policy developments. One of the most significant factors influencing investor sentiment is the shifting outlook for U.S. monetary policy. The market is increasingly confident that the Federal Reserve is poised to begin cutting interest rates to support the economy. Futures markets are now pricing in an overwhelming 88% probability of a 25 basis point rate cut at the Fed's upcoming September 2025 meeting. This expectation is creating a powerful tailwind for assets like Bitcoin. Lower interest rates are generally bullish for non-yielding assets like Bitcoin and gold. When the return on holding cash or government bonds decreases, investors are more inclined to seek out alternative assets that offer the potential for higher returns and protection against the currency debasement that can accompany looser monetary policy. The anticipation of Fed rate cuts makes holding U.S. dollars less attractive and increases the appeal of scarce assets like Bitcoin, which has a fixed supply. All eyes are now on upcoming U.S. inflation data and the Federal Reserve's annual Jackson Hole Symposium for further clues about the central bank's future path. Beyond monetary policy, a resolution to a long-standing legal battle has removed a significant cloud of uncertainty from the cryptocurrency industry. The U.S. Securities and Exchange Commission and the company Ripple recently agreed to end their protracted lawsuit. While the case was specific to Ripple's XRP token, it was widely seen as a bellwether for the regulatory treatment of digital assets in the U.S. The conclusion of this legal fight has been interpreted as a positive development for the entire sector, reducing regulatory risk and signaling a potential move towards clearer rules of the road for crypto companies operating in the country. This improving macroeconomic and regulatory landscape is being reinforced by a steady drumbeat of corporate adoption. Companies like MicroStrategy, led by its vocal Bitcoin advocate Michael Saylor, continue to add the digital asset to their corporate treasuries. MicroStrategy now holds a colossal $76.8 billion worth of Bitcoin, treating it as its primary treasury reserve asset. It is not alone. A growing cohort of public companies including Empre Digital and Metaplanet are following this strategy, viewing Bitcoin as a superior long-term store of value compared to cash. This corporate buying provides another steady source of demand, further tightening the available supply and supporting the price. Perhaps one of the most important long-term developments for Bitcoin is the notable decline in its price volatility. For years, the asset's wild price swings were a major deterrent for conservative institutional investors like pension funds and insurance companies who prioritize stability and predictable risk. However, the massive influx of institutional capital through spot ETFs appears to be having a profound stabilizing effect on the market. Bitcoin's 90-day rolling volatility has recently dropped below 40 for the first time since the ETFs were launched in early 2024, a significant decrease from the levels above 60 seen at their inception. This reduction in volatility is best understood when compared to traditional assets. Before the launch of the ETFs, Bitcoin's price swings were often more than 3 times as volatile as those of gold, as measured by the GLD ETF. Today, that gap has narrowed considerably, with Bitcoin's volatility now less than twice that of gold. This is a crucial development. As Bitcoin begins to behave more like a traditional financial asset and less like a speculative lottery ticket, it becomes a much more palatable option for the world's largest and most conservative pools of capital. Lower volatility makes it easier for portfolio managers to model risk and justify allocations. This newfound stability creates a virtuous cycle. As volatility decreases, more risk-averse institutions feel comfortable entering the market. Their large long-term investments in turn add further stability and liquidity to the market, which helps to dampen volatility even more. This dynamic is essential for Bitcoin to transition from a niche alternative asset to a globally recognized component of mainstream investment portfolios. The success of the ETFs has kickstarted this process, providing the initial shock of institutional capital needed to begin smoothing out the price swings that once defined the asset. In conclusion, the current Bitcoin rally to over $122,000 is built on a powerful and reinforcing foundation of diverse factors. The historic success of U.S. spot ETFs, led by giants like BlackRock, has unlocked unprecedented institutional demand. This has been supercharged by a favorable policy shift from the Trump administration, opening the massive $12 trillion 401k market to digital assets. Real-world adoption by sophisticated investors like Harvard's endowment, coupled with a bullish but rational options market, provides strong evidence of this new reality. As all these forces work to reduce volatility, Bitcoin is maturing before our eyes, becoming a more stable and attractive asset for the future of global finance.